Trading is now live for Canary Capital's spot XRP ETF on the Nasdaq under the ticker XRPC. For the first time, investors can get exposure to XRP through a traditional brokerage account. No wallet, no keys, no crypto exchange, just a ticker. In this episode, we're going to unpack what this new ETF really is, what it changes for XRP and payments infrastructure, and whether the hype around it is justified or overblown. The Canary XRP ETF is a spot ETF, meaning it's designed to hold actual XRP in the fund and mirror its value, minus a sponsor fee and expenses. It's listed on the Nasdaq as XRPC, and it's being pitched as the first way to access XRP entirely through familiar systems: standard brokerage accounts, retirement accounts, and IRAs, regular account statements, and simplified tax documentation. In other words, the fund's stated objective is not to be a leveraged bet, not a synthetic derivative, but simply to mirror XRP's price, less fees. The message from Canary Capital is clear. This is about access and discipline, not about hype. In today's financial system, most money still moves on legacy rails. Transfers can take hours or days to settle. Cutoff times slow everything down. Fees chip away at working capital. As the pace of the world accelerates, the pitch for XRP is straightforward. Fast settlement, typically 3 to 5 seconds, predictable and low fees even at scale, 24/7 availability, and the ability to move value across currencies and networks in real time. Supporters argue that XRP already underpins real-world settlement across networks, banks, fintech companies, and cross-border payment providers. The ETF is presented as a way to bring that payments-focused technology into regulated markets in a format institutions and traditional investors understand. Under the hood, the Canary XRP ETF follows a relatively simple structure. Custody is handled by BitGo, a well-known institutional digital asset custodian. Administration is provided by US Bank, which oversees reporting and compliance. The sponsor fee is listed as 0.50%, positioned as clear and competitive for a single asset product. There's no leverage, no synthetic baskets, no complex overlays. The goal is to make XRPC operate much like a traditional single asset ETF, creations and redemptions handled by authorized participants, support for liquidity and price alignment, and a structure that fits into existing advisory and RIA workflows. The sales pitch is simple: buy a ticker, rebalance like an equity, track your cost basis automatically under established regulatory oversight. Most digital asset ETFs to date have leaned on two major narratives: digital gold, like Bitcoin, and smart contract platforms like Ethereum or Solana. Canary's XRP ETF consciously takes a different angle. It's marketed as payments-first utility, XRP as a rapid settlement layer with stable and predictable costs and efficient currency routing, rather than computation-heavy smart contracts. In this framing, XRP is positioned less as a store of value or a world computer, and more as a specialized tool for moving value across currencies and borders in seconds. The script also points to a broader trend: Web3 utility reaching the retail layer. For example, the Uphold debit card offering 6% back in XRP on spendable charges wherever Visa is accepted, and the Gemini Solana card rewarding purchases instantly in SOL. These products are used as evidence of growing mainstream demand for crypto rails in everyday payments, not just in speculation. In that context, XRP's ETF is framed as another bridge between crypto payment rails and traditional financial infrastructure. To support the case for demand, the script highlights recent ETF launches in the Web3 space: a Bitwise Solana ETF, which reportedly saw around $55 million in first-day volume, helped by a temporary 0% fee promotion; an Osprey XRP product described as drawing $24 million in volume within its first 90 minutes and surpassing $100 million in assets under management, within a few weeks. And a Hedera ETF, reported to add about $8 million on its opening day. The takeaway Canary emphasizes is simple. When access is easy and friction is reduced, activity tends to accelerate. The script also references a number of analyst predictions and price targets, ranging from very conservative to extremely aggressive. Among them, Jeff Kendrick of Standard Chartered is cited as predicting XRP could reach a base scenario of around $12.50 by 2028 under favorable conditions, potentially closing in on or even surpassing Ethereum's market cap in some scenarios. Kendrick is described as viewing XRP's utility in fast, efficient institutional transactions as comparable in some ways to stablecoins. And then there are even more extreme forecasts, like targets as low as roughly $1.35 from more cautious models, and as high as $1,000 in very bullish scenarios, attributed to specific figures building in the XRP space. The script itself acknowledges that predictions vary wildly, and that only time and real demand will tell which, if any, prove accurate. These are projections, not guarantees. They reflect opinions, not certainties. One of the boldest statements in the script comes from Stephen McClure, CEO of Canary Capital. He is quoted as projecting that up to $5 billion in institutional inflows could move into XRP within the first 30 days, vastly exceeding Ethereum's ETF entry performance and even surpassing Bitcoin's ETF launch metrics. Those numbers are, again, forward-looking statements. They signal confidence and ambition, but they are not outcomes that can be verified yet. The script then lists several reasons why some investors are watching this moment closely. First, proven demand. Previous Web3 ETFs in Solana, Hedera, and XRP have seen substantial early volumes when access friction was reduced. Second, payments, first utility. XRP's speed and consistent fees set it apart from digital gold and compute-focused tokens. Third, enterprise adoption. References to Ripple's acquisitions and integrations, aiming to bring institutional workflows on-chain. Fourth, treasury synergy. Corporate treasuries seeking instant visibility and settlement are seen as a potential match for real-time rails. Fifth, consumer reach. Visa-linked debit cards with XRP rewards demonstrate live retail usage. Sixth, analyst convergence. A wide range of price targets, with Kendrick's 2028 prediction used as one focal point of institutional optimism. Seventh, operational simplicity. The ETF offers single asset exposure, familiar fees, and reporting structures that fit existing processes. And eighth, custodial confidence. BitGo Trust and US Bank are framed as minimizing operational risk for institutions and larger investors. Holding XRP directly means managing private keys, wallets, exchanges, and custody risk. For many institutions, and even for a lot of retail investors, that's a barrier. The ETF model tries to remove that friction, buy a ticker, rebalance like a stock, track cost basis automatically, and leave custody to a regulated provider. The script also notes that some banks restrict direct digital asset purchases and presents ETF wrappers as a compliant alternative for gaining exposure. Canary positions this ETF as a pure play on the payments lane of the crypto universe. Not on compute-heavy DeFi, not on smart contract ecosystems, but on moving money across currencies in seconds. In their framing, simplicity is a feature, not a limitation. Single asset, clear fee, and a clear role in cross-currency payments and settlement. If your thesis includes growing demand for real-time settlement solutions in an always-on global economy, Canary argues that this ETF is one way to express that view. The script repeatedly stresses that this content is for educational purposes and not financial advice. Before investing, viewers are urged to review the S1 filing, read the corporate deck and fact sheet, check the fee disclosure, and consult a regulated financial advisor for personalized help. Those documents are presented as the primary sources for understanding the product's risks, mechanics, and costs. So, what does all of this actually mean for XRP and for you as an investor or observer? A spot XRP ETF like XRPC does not change the fundamentals of XRP overnight, but it does change access. It lowers the barrier for both institutions and retail who prefer regulated brokerage channels. It adds another way to size and express a thesis on XRP's role in real-time payments. And it contributes to the broader story of crypto rails quietly moving closer to traditional finance. Whether that translates into the kind of inflows and price action some people are predicting is still an open question. As always, utility, demand, regulation, and execution will matter more than headlines. If you found this breakdown helpful, leave a comment with your view on whether an XRP ETF is a game changer or just another product. Hit like so more people see a balanced view instead of just hype. And subscribe to XRP Daily Brief for more short documentary-style deep dives on XRP, payments, and the future of money.